Okay, I am trying to make the videos and my website a little more organized and include a lot more theory behind what we're doing and a lot more explanation. So, as my friend I met, Carmen in Indonesia, told me, you've become too Excel technical and not enough about some of the structuring theory. So I'm going to talk about project finance structuring here. And here, the interesting thing for me is that there are all sorts of different issues ranging from here. What do I have? Well, let me talk about the financing issues. DSRA accounts, credit spreads, risk premium, letter of credit fees, refinancing, mini perms, cost of capital from yield codes. Then there are all sorts of, I shouldn't have just scratched my beard, by the way. I don't have a beard, whatever. Then there are all these other issues associated with how to structure contracts. So I'm going to put this video I'm making, hopefully, right here. I hope it's not an embarrassingly crap video. And then here's what I think. When we talk about project finance structuring, project finance is a form of debt. And the debt is there. I say you can boil down the whole everything about debt into 5 separate parts. One is the size of the loan, then how we borrow money, then how we repay it. We better repay it. And then the interest and the fees, the same kind of thing, interest and fees that you pay in between. And then all these other things that protect the loan, like, covenants and all that. And I wish that these term sheets had some logic to them and put the debt size in one place, the funding in another size, the way you repay it in another, but they don't. And then I also want to talk about some contract structuring and tax issues, okay? And so then what I have done is put lesson sets associated with debt sizing. I haven't kind of put all the videos together. I've made some of them. I'm going to improve some of them. I'm going to modify some of them. And then we have some files and issues associated with borrowing the money. Then we have a whole lot of files. Well, the biggest one is sculpting on how to repay the money and associated interest issues, and then how to, in between, what kind of credit spreads, what kind of hedging, all the interest rate issues you might have then, and then some credit enhancements. You can see I haven't quite finished this. And then finally some contract issues and some equity investment issues. Now, I am going to do something a little to explain these things. Oh no, I don't want to do all this crap. Oh shoot, sorry about that. Oh, come on. Okay, I have an outline that I kind of made, and it's difficult for me to sometimes stick to outlines. But I have a course that's on kind of the structuring issues, and in this course I went through kind of how mini perms work, what happens when you have local bank debt and some currency issues, what kind of development fees you should assume, what if you partially sell a project, how do you account for letter of credit instead of a DSRA account, all of these subtle kind of issues. And then what I said, well, this course, I tried to teach it without a bunch of Excel. Okay, and they made me put specific kind of timelines. And the first thing to talk about is just what is project finance. Now, I hate these stupid definitions you get in this either books or Harvard Business that say, oh, project finance is some kind of single entity that's financed with non-recourse debt and you use cash flow. Those are all true, but the real definition of project finance is centered a lot around DSCR. Here is this formula. DSCR equals the cash flow to get to a break even is DSCR minus 1 over DSCR. Not exactly to the DSCR ratio. project finance is triple B, and most importantly, project finance is about phases. I keep on using my marriage example, but I think it's true. It's a lot of contracts and phases and risks that you're going to break the contracts and all that stuff. Development period is your dating period and all. Then you hit your financial close when you're going to get engaged, and then you hit your commercial operation date. It's your wedding date and all that. So I start out by just really defining project finance's phases. The important thing is that the risks of a project change in the different phases. You need to understand that. And then we go through the incentives and the bad way that some of these contracts are written. And here, this, again, I'm complaining about some of these discussions and technical discussions about a bunch of crap. Here's what really happens. You get money in, and then you pay money out, and you've got a little shell company here, and you pay all the money out with different kind of contracts. If you don't get the money in, you have nothing. If you don't have a PPA contract in electricity, you have nothing. If you don't have a way to get money to the project from a merchant power or anything, that's where you better start the analysis. And then the contracts come off of there. So if in the PPA agreement we have something called a liquidated damage, we put that in the O&M agreement or the EPC agreement. The other thing you should realize is basically you're taking this money and you're parceling it out to different people, and those people better be paid fairly for the risk. If you're just stealing money from these poor government agencies or something, then eventually you've got political risk. If you're paying the EPC too much, then you get paid less. If you're paying the O&M too much, you get paid less. Those kind of issues, and more importantly, how to structure the damages and make them so they reflect the off-taker cost, because if you don't do that, you're going to have real distortions. You're going to pay too much for O&M or EPC and all that. That's all in lesson set 6. And then we go through the kind of just how the bank looks at this and a little bit. And then here's what I think is a big deal, is how much do these little things, seemingly little things, they add up. How do we get the levelized cost of electricity in an electricity project low enough by doing all sorts of things with credit spreads, with DSRAs, with sizing debt, with making the debt longer, with changing even the IRRs on the equity? How do you explain kind of how that works? And I have a lot of things I've shown you before where we show you that just how dramatic the financing can be, particularly on capital intensive projects. And then I start with the debt sizing. And the debt sizing, the first big thing about the debt sizing is, and I think I'm going to include this little outline on the spreadsheet, is that you can either size the debt, either size the debt on a forward-looking DSCR. Somebody recently said, you have to negotiate the base case. I thought you kind of just made assumptions. No, you negotiate a base case with a bank, and you negotiate the debt-to-capital ratio with a bank. And the strategy, only one of those two things can drive the level of the debt. At the end of the day, it might be similar. Now, I have a whole lot of files in here, and I'm going to open a file in here. So I'm going to go to my course file, and then I'm going to go to Chapter 1. I'm going to go to Project Finance, and I call these Advanced Issues and Structuring. And the folder number 1, what I've tried to do on this one is, I better enable the contract. And I've put a little test so you can take a test. I hope this goes to the output properly. And you can see, here the debt to capital is causing the constraint. Now, if you make the project IR go down, we hit a DSCR constraint. Now, if you would make the interest rate change, Then we hit the maximum gearing constraint. But if the interest rate goes up, we hit the DSCR constraint. To understand which is driving the model, and when you have a consistency between the DSCR and the debt to capital, that's what I consider a tricky little issue. It's not as simple as some of the others. If we change the loan tenor, right now, then we hit the maximum gearing constraint if it's shorter. So you need to understand what's driving your debt size. That's such a crucial issue. It's behind so much of this. And you can say, oh, the banks, they always figure it out. They figured out what the right debt size for the DSCR is. What? No, they don't. You get to negotiate a little bit with that, and they have kind of rules they use, and then you have to work with them. Now, if the debt to capital is the constraint, then here's what you can do. Then, accounting allocations have a big effect, and the banks like to say you need to put skin in the game, skin in the game, skin in the game. So they don't want you to start writing up assets and then issuing debt against things that you haven't put down as cash. For me, development fees are a classic example, but there are so many others. A wonderful example is interest during construction on shareholder loans. You understand that if you just issue equity, you don't get to record interest. If you have a shareholder loan and you capitalize the interest, that write up the cost of the assets compared to if you just had equity, and that could make a difference. That could increase that shareholder loan that should have nothing at all to do with anything, who cares how you finance the shareholder part of it. If you record that interest during construction, you get a kick up in the profit. How interesting is that? Now, it's the same thing with now when you have EPC contractors. If you're the EPC contractor and debt to capital is the constraint, you want to increase the EPC cost. If it's not, who cares? O&M contracts are really interesting too. If you put a lot of profit on the O&M, you're going to reduce the cash flow. If you reduce the cash flow, you reduce the debt. There's also all sorts of different things from the bank perspective, whether all these profits, where they come from in the cash flow waterfall. Fascinating issues. Now, now we turn to funding. Remember, the first thing was sizing. This is kind of the sizing section. And then we turn to funding. Funding of the debt, there are games to play there. That IDC on the shareholder loan is almost a funding issue, but what happens if you have two solar projects and you divide them into pieces in the pre-operating cash flow? Should that be recorded as equity or a reduction in assets? Who cares? Who cares? Who cares? You know how big a deal that is? If you record it as equity, then you have to put less of your own equity in. You're paying for the project by splitting it up into two pieces. Equity bridge loans are so interesting too. Equity bridge loans say, okay, we're not going to put any of our own money first, we're going to put it in last. If you put it in last, the IRR is going to go up. So I have, exercises here. Where is the exercise? Somewhere I should find this on the, just a minute. See, these should be, I'm rearranging them so they're in the right order. And then we have operating cash flow during construction and equity bridge loan. So it would be a similar kind of thing where you would go through and you'd isolate only on these things about operating cash flow, and then when you do that here, a pre-COD is equity, oops, just a minute, let's make a high pre-operating cash flow. We get a different IRR on the equity. I'm always looking at it with and without the equity bridge loan, and we put different assumptions in, and then what you're supposed to do is go through all of these and really understand how the modeling works and why these nuanced kind of issues occur. Okay, I'm going to try to get through this fairly quickly now because I'm already at 15 minutes and I'm trying to keep my videos to a reasonable amount. Now, when we get to sculpting, there are so many issues with sculpting. I have this whole sculpting course, but what interests me is going to this reverse sculpting. You see some places like Pakistan and Malaysia where they have capacity charges that have a step down. That's really related to, the bank says 10 years flat, debt service period, and then you sculpt around that. In Brazil, they do it with O&M expenses for various reasons that you'll see when you watch some of the other videos. I hope. Then the length of the debt is a crucial issue, but nowadays we have these mini perms, these hairstyles, hard or soft mini perms. Are we going to some kind of hairdresser? I don't have enough hair left myself, but then I could ask for a soft mini perm or a hard mini perm. The real interesting thing about that is what do you do about the refinancing assumption in there? Okay? And the banks treat it differently, and then we get into the interest rate. So now we've paid off the debt, and now we're in the interest rate. And this is just, for me, whether it should be variable or fixed. Should we end up paying for a liquidity premium in our interest rates because the banks are worried about fixing everything, or if we have some inflation, should we allow for some variable rates? But much more important, what's the right level of the credit spread? Now, when you have credit spreads, there are a whole lot of tricks when you have multiple currencies. And you think a credit spread, let's say we have an interest rate of 15% in rupiah in Pakistan. Is that high? That's low. If the inflation rate is 14%, that's an amazingly low rate. You better adjust not only the base rate, but also the credit spread when you're really carefully looking at which kind of currency to borrow in. And then you have all these risk differences, of course, that you have to account for as well. And finally, we have the credit enhancements. And for the credit enhancements, I really think this is a risk versus return kind of analysis. And the cash flow sweeps, for example, they kill the IRR, but if you put refinancing in, they're not quite as bad as you thought they were at first. Okay, and then I talk about these tax effects of these U.S. projects. One of the crimes, I'll get into that later, but essentially it's an enormous gift to people who still pay, corporations who still pay taxes, because the interest rate should be remarkably low on a flip structure. It should be much lower than any other interest rate. They're getting all the cash flow first. They're getting a very low risk cash flow, but they get a really high rate, which means somebody else gets to pay. Enough of that. And then we went through some P90s and P50s and all that, and I really want to go through some of that. Okay, so that's the introduction, really, to some of the structuring issues, and for each one of these issues, I'm going to put a separate video on. Whoops, you saw that. I'm getting some healthcare. Okay, good. All right, that's it. So that's where this video hopefully will go. Goodbye.